This is ShadowQuant Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, July 27, 2026, and this is the New York pre-market. Now, let's get into it. The Nasdaq 100 has structurally fractured. QQQ is sitting at $684.23, hovering inches above a critical technical floor at $682.48, while the broader S&P 500 holds steady at $738.93. We are witnessing a clean, violent decoupling. Large cap growth is shedding beta, and capital is rapidly rotating into defensive value. Before we dissect the technicals, let's look at the schedule. Later today, we get durable goods orders and the Dallas Fed Manufacturing Survey. Both are expected to provide fresh data on industrial activity and inflation pressures heading into the weekend. On Tuesday, Case-Shiller home prices will offer a snapshot of the housing market's temperature. By Wednesday, the market turns its eyes to the Federal Reserve for the FOMC rate decision. Finally, on Thursday, the gross domestic product print will give us the definitive read on Q2 growth. Apex notes that the durable goods and Dallas Fed surveys are the immediate focal points. They will either validate the current inflation fears or provide a glimmer of relief for the rate-sensitive assets currently under siege. Here is the snapshot as of 9:20 ET. SPY is essentially flat at $738.93, up just 0.1%. Diamonds is slightly stronger at $518.76, up 0.48%. But look at QQQ. It's down 1.12% at $684.23, testing the lows of $682.48. IWM is down 0.31% at $291.17, showing surprising resilience. Sector-wise, we see a massive divergence. The technology sector is down 1.44%, while the real estate sector is surging 2.22%, and the materials sector is up 1.93%. The story isn't a market crash. It's a sector-specific exodus from growth into value and defensives. Let's bring in the team to unpack this structure. First headline, RIGD Computing, RGTI, is gapping up 5.2% on news of expanded collaboration with HPE and the Pittsburgh Supercomputing Center for Hybrid Quantum Classical Computing. Second, SPECTER Therapeutics, SRPT, is up 4.6% on the appointment of Michael Severino as CEO. Third, Bank of America is calling the semiconductor sell-off a prime entry point for SDM, even as Micron, MU, shows bearish news sentiment. Pulse, how does this mix of specific stock catalysts fit into the broader sentiment landscape?
It's a classic fragmentation signal. You have micro-cap and niche name pumps like RGTI and SRPT driving localized volume, while the broader equity complex is struggling with the weight of QQQ's breakdown. The sentiment isn't broadly bullish. It's opportunistic. Traders are picking apart the wreckage of the tech sector for specific wins rather than trusting the index as a whole. That's not confidence. That's survival mode.
So we're seeing noise, not signal. What about the risk angle? SPECTER, is this prime entry point narrative from BOF for SDM masking a larger trap?
It absolutely is. Look at the VIX. It's sitting at 18.58. Effectively flat despite QQQ dropping 1.12%. That is a dangerous divergence. Price is falling, but volatility, the insurance policy against risk, is not rising. When you combine that complacent VIX with the buy-the-dip rhetoric on semis, you're looking at a scenario where the market assumes safety in a falling knife. The lack of a VIX spike during this tech breakdown suggests the downside move hasn't been fully priced in yet. It's a quiet accumulation of tail risk.
Let's talk about the fracture point. QQQ at $684.23, down 1.12%. It is testing the 5-day low of $682.48 established on July 24. Grid, what does the chart structure tell us right now?
The structure is deteriorating. QQQ has been trading in a 10-day consolidation range between $682.48 and $724.36. We are currently at the very bottom of that box. The price action of $684.23 is perilously close to the absolute floor. In a normal consolidation, you'd expect a bounce off the lows. Here, we're seeing sustained pressure right at the support line. If we lose $682.48 decisively, we aren't just talking about a pause, we're talking about the breakdown of the entire accumulation phase. The next structural support zone opens up significantly lower, leaving this level exposed.
CIPHER, is this breakdown driven by technical stops, or is there actual flow pressure behind it?
It's flow-driven distribution, not just technical stops. Look at the sector divergence. The technology sector, is down 1.44%, but more importantly, consumer discretionary is down 5.22% on the week. That is a massive weekly bleed. Institutional capital is actively exiting high-duration assets. They aren't waiting for QQQ to break $682.48 to sell. They've been selling into strength for weeks. The breakdown below $682.48 is just the final confirmation of a trend that started weeks ago. The money isn't hiding, it's moved to real estate and materials.
SPECTER, you mentioned earlier that the VIX staying flat is concerning. How does that interact with QQQ breaking support?
That's the core danger. Normally, when an index like QQQ breaks a key support level like $682.48, you expect fear to spike. The VIX should jump. Instead, it's sitting at 18.58. This tells me that options dealers are still comfortable hedging, or perhaps retail traders are stepping in to catch the falling knife. But price action doesn't lie. When price breaks down and volatility stays suppressed, it means the market is ignoring the structural weakness. Once that VIX finally wakes up and spikes above 20, the speed of the decline accelerates because everyone realizes they are underhedged simultaneously.
Apex, connect the dots. Grid sees a structural break at $682.48. CIPHER points to weekly distribution in consumer discretionary, and SPECTER warns about suppressed volatility. What's the takeaway for QQQ?
The takeaway is that QQQ is isolated. Grid correctly identified the $682.48 floor as the immediate threat, but CIPHER point about consumer discretionaries, 5.22% weekly collapse confirms this isn't a temporary glitch. It's a confirmed style rotation. SPECTER observation on the VIX at 18.58 reinforces that the broader market hasn't reacted with enough fear yet, which leaves QQQ vulnerable to a sharper move if that support fails. We are watching a slow leak turn into a rupture.
While QQQ bleeds, capital is flowing elsewhere. The real estate sector is up 2.22% today at $45.95, and the materials sector is up 1.93% at $51.26. Even IWM is holding relatively steady at $291.17, down only 0.31%. CIPHER, where is this money actually going?
It's a flight to tangible assets and yield. Real estate, the real estate sector, and materials, the materials sector, are benefiting directly from the higher for longer rate narrative. With CPI at 3.46% and core PCE at 3.41%, the Fed is unlikely to cut aggressively. That hurts tech multiples, but it helps assets that generate cash flows independent of future growth expectations. Also, look at IWM at $291.17. It's holding above the $290.17 support level from July 23. Small caps are acting as a haven here, not a risk asset. Institutions are rotating into small cap value, possibly anticipating a flattening yield curve where industrials and smaller firms with less debt exposure might outperform.
Grid, from a technical standpoint, are the real estate sector and the materials sector showing signs of topping, or is the breakout still valid?
Both are showing strong upward momentum relative to the index. The real estate sector's gain of 2.22% today pushes it higher in a clear uptrend channel. More importantly, look at the relative strength line against QQQ. As QQQ makes lower lows towards $682.48, the real estate sector is making higher highs. That inverse correlation is strengthening. There's no resistance overhead for the real estate sector in the immediate term. The breakout is technically valid. Same for the materials sector at $51.26. They are decoupling completely from the Nasdaq's drag.
Pulse, does this rotation reflect a fundamental shift in investor psychology, or is it just a short-term hedge?
It feels like a defensive crouch. You don't rotate into real estate and materials unless you're worried about the economy slowing down or rates staying punitive. The sentiment isn't bullish on value, it's bearish on growth. The fact that consumer discretionary is down 5.22% on the week tells me consumers are pulling back. Investors are treating the real estate sector and the materials sector as bonds with equity risk profiles. It's not excitement, it's preservation.
SPECTER, is there a risk that this rotation is also fragile?
Yes, because it's driven by fear, not fundamentals. If the VIX eventually spikes due to external shocks, correlations converge. Right now, when QQQ drops, the real estate sector rises. But in a true liquidity crunch, everything sells off except cash. The fact that IWM is holding at $291.17 is reassuring now. But if credit spreads widen, which they might given the flat 10-year, 2-year spread of plus 0.36 pp, small caps will likely succumb to the same pressure as large caps. Don't mistake defensive positioning for safety.
Let's address the epicenter of the weakness. Technology, the technology sector, at $175.88, down 1.44%. Micron Mu is showing bearish news sentiment at 0.71. Yet, BofA is calling SDM a buy. CIPHER, is there any merit to the idea that this is a buying opportunity for chips?
There is zero merit to buying chips right now based on news sentiment. MU's sentiment score is deeply negative at 0.71. When the leader of the pack shows that kind of distress, it's a canary in the coal mine. The BofA note on SDM is an outlier attempt to create narrative support, but the flow data doesn't lie. Institutional investors are reducing exposure to the semiconductor complex until MU finds a bottom. The technology sector will continue to face headwinds. This isn't a prime entry point, it's a value trap waiting to trigger.
Grid, what does the technical picture look like for the technology sector as it drags QQQ down?
The technology sector is acting as the anchor. At $175.88, it's not just following QQQ, it's leading the decline. The sector ETF is breaking its own internal support structures. Usually you want to see the leading sector hold while the broader market corrects. Here it's the opposite. The breakdown in the technology sector confirms that the trend change is broad-based within the tech sector. There's no technical support visible immediately above $175.88 that can halt this momentum. The path of least resistance is down until a clear base forms.
SPECTER, you've warned about the VIX suppression. Does that apply here too?
Perfectly. The VIX at 18.58 is suppressing the fear response for the technology sector. Traders are shrugging off the 1.44% decline because the overall index looks calm. That complacency is what makes the decline insidious. If the technology sector were to break below $175 and suddenly the VIX spiked, we'd see a rapid unwind of positions. The disconnect between price action and volatility is the biggest risk flag in this entire data set.
Apex, summarize the tech thesis. CIPHER points to MU's negative sentiment, Grid shows the technology sector breaking support, and SPECTER highlights the VIX trap. How do we navigate this?
We navigate it by acknowledging that the buy-the-dip narrative is currently at war with price action. CIPHER data on MU shows institutional avoidance, which Grid confirms via the breakdown in the technology sector at $175.88. SPECTER's warning about the VIX at 18.58 means we shouldn't trust the calm. The consensus is waiting for a rebound that the data hasn't triggered yet. The safest play is to observe the $682.48 level on QQQ and the $175 area on the technology sector. Neither has stabilized.
To wrap up our equities edition analysis. First, the Nasdaq 100 is structurally compromised, testing critical support at $682.48, while the S&P 500 remains artificially stable at $738.93. Second, capital is executing a deliberate rotation out of growth and into defensive value, with the real estate sector and the materials sector leading gains, while consumer discretionary suffers a 5.22% weekly drawdown. And third, the suppressed VIX at 18.58 amidst falling tech prices suggests the market is underhedged for a potential acceleration in downside risk. Tomorrow, watch the durable goods data to see if the economic backdrop supports this continued flight to safety. Thank you for listening to ShadowQuant Equities Edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.